All right. Hello, everyone. Thanks for joining us today for our December market update. I'll be running through a little bit about our portal just to make a start, and then handing over to Philip, who will take you through the market update for this quarter. So just a quick update on where things are at with our portal. We've now getting and onboarding our clients into the portal. All of our invites have now gone out to all of our clients. So if you haven't received it, please check your junk email folders. If you haven't received it in your junk folder or your inbox, you can email portalsupport@performanceproperty.com.au and we'll send your individual invite out to you. So the portal is open to active clients of Performance Property only at this stage. So you'll need to be an active client to get an account there, or one of our strategic business partners. The features that are currently live include access to our new online research reports, which are all up there in the portal now. We've got some live investment opportunities that the investment team on the ground have been looking at. And we've also got a referral program for our clients who want to refer family, friends, and colleagues into us as a business. The features that we're currently working on, including the portfolio modelling tool. All of your advice meetings will also be handled through the portal, and you'll be able to see notes from those meetings in the portal as well. And then we've got some reporting that we're building out, including consolidated portfolio reporting, financial reporting, and tax reporting, which you'll be able to send over to your accountant at tax time. So those features will be coming in the new year. So it's important that you have your account ready so that we can run your meetings as of next year. So I'll hand over to Philip now, who'll take over the presentation. And can you hear me there, Phil?
I can. Thanks, Paul, and thanks for that update on the portal. It's very, very exciting in terms of obviously discussing where it's got to and where it's getting to now. So so if you all want to jump on that link, I think it'd be a great help in terms of the advisors being able to run your portfolios in a methodical, process-driven manner, and obviously overlaying that with all the data there that we more than happy to share if you're a client. So first of all, before we go on, obviously any of the advice that we probably go through, any of the data that we go through is general in nature. So if you do want to have a chat about your personal position, just reach out to your advisor or strategic property advisor, and we're happy to sit down and have a chat about your position. So just recapping in terms of the life cycle of all of our clients, in terms of the different life stages that they go through, in terms of the debt reduction strategy, the upgrading of the home, paying off the home over time, and that takes a long time to do. And obviously a lot of our clients that are building out these 5, 10, 20 mil portfolios are moving into that wealth creation phase of their lives. And our clients that have been with us for over 11 years now are definitely moving into that phase. And some of our older clients now are almost moving into that retirement phase. So it's been really great to see the journey in terms of where they've started with us and where they've got to. So, and what we'll probably share in the next kind of update next year is probably our Acheson performance, which will be just give you a bit of an overview in terms of how it performed as a business to date and auditing our own performance in comparison to the market. So look, I'll talk about the investment basics again in terms of, a growth portfolio, an income-based asset, a foundation and trading. So when we're talking to our clients, we're having a number of discussions around what sits in their portfolio as a foundation asset and what sits in their portfolios, often a trading asset. Most of the trading assets are probably anywhere between 6 and 9 years sort of holds. They're purely utilized to look at paying down debt on their family homes or their upgrader homes. Usually they're high growth assets, and the timing of these residential markets is really, really important when we're looking at these assets. Often they're investment grade and they're in growth markets across Australia. The foundation assets, these are assets that we're putting into clients' $5 and $10 million portfolios that are more specifically long-term holds. And we're putting in and implementing 25 years sort of maintenance programs and making sure they're really well looked after. because the intention there is to create value along the way, increase the rent, make sure these buildings are really well maintained, and they're long-term holds. So they're in very much high quality locations across Australia. Now, in terms of obviously the national markets, in terms of where we're seeing the unit market versus the kind of housing markets, very, very different currently. You can see that Brisbane at the moment is going through a fairly significant growth run. In terms of some of the rental increases we've seen over the last, say, 12 months, rents are increasing on the ground in Brisbane. From a capital growth point of view, we don't see that market slowing down for another 12 to 24 months. So it's been a lot more challenging for us to buy on the ground in Brisbane. You know, the price point for good quality assets at the moment are probably sitting between, say, 1.2 and 1.6 mil for really good quality housing at the moment. We're very, very busy in Perth. It's all systems go over there in Perth. Our buying team on the ground is extremely busy. We're finding that the market's probably softened in terms of our access to get really good quality stock has opened up for our senior buying team on the ground. So there are really good opportunities anywhere between, say, 800 grand to $1.5 million price bracket in the housing sector. And we are seeing really good opportunities in the unit sector as well on the ground over there between, say, 500 to 700K for those entry-level assets. So the Perth market is probably still representing really good opportunities. There's a little bit of a dip during that Christmas period in Perth. So I think the next 2 or 3 months in Perth might represent really good buying opportunities at the moment. And we are seeing a lot of really good quality stock coming through with the advisory team on the ground. The other market that we're concentrating on quite aggressively at the moment is Townsville. Now, Townsville, Gladstone, there's probably good buying opportunities within that, say, 500 to 650, 700K mark. So predominantly we're doing a lot of buying in the housing sector, townhouses, houses on good blocks of land. And the yields on those are actually quite attractive. So, we're buying housing for around that 6 to 650 mark and generating rents of around that 5 to 550 mark. So very attractive at the moment. The other market that is, fairly exciting, and I think we touched on this in the last research presentation, is Melbourne. A lot of investment activity in terms of investors exiting the market. I think people's cash buffers have now run out in Melbourne. I think in terms of their serviceability on their principal place of residence, that's starting to bite as well. So if there's, clients, they're looking to buy their house between that $1 and $2 million price point, I think there's going to be some attractive opportunities in that market. And our advice for kind of Bendigo and Ballarat is definitely don't sell, retain, hold those particular assets. It is flat at the moment. From our end, but we see that as probably a good buying opportunity at the moment. So any clients that are holding assets in Ballarat or Bendigo, our strong advice is to hold, because we see those markets really improving, very sensitive to the interest rate environment at the moment. So, our advice is for any client holding an asset in those two markets is to hold for now. This is probably our forward view, and I think we touched on this in the last research meeting, but this is probably a forward way in terms of what we've come up with in terms of having a forward view in terms of the residential housing markets, where the kind of residential unit markets are going to go. So you can see one of the axes is the demand. So probably in terms of the matrix, in terms of where you want to be, you probably want to be concentrating on markets in that high demand, long runway. And they're usually assets that are in that buy momentum stage where you're going to get some pretty reasonable growth in the short term to medium term. The markets there that probably are in that low demand, short runway sort of down here, you might have a sell recommendation on that asset, or there might be an ability to liquidate that asset and recycle some of the debt. So we take a forward view in terms of that previously, in terms of and applying it to the housing market across Australia, you can see that in this quadrant here, the Townsville, Mackay, the Cairns market, Darwin markets, and you can see Perth is still in that quadrant. So probably the runway for Perth is still quite attractive from an investment point of view over the next 12 to 24 months in our view. Brisbane's probably in that mid-range now, and Melbourne's really moving along towards this quadrant here. Again, the markets you probably want to be staying away from right now are probably areas like Newcastle, Central Coast, Greater Sydney, Wollongong. But definitely areas like Melbourne are probably moving into this particular quadrant here. And you can see that Bendigo and Ballarat still are in that sort of mid-range section here. So, our strong advice is to retain and hold those assets if you can for the time being. But definitely kind of Townsville and Greater Perth are probably the markets to be positioned in right now for the next 6 or 12 months in our view for housing. If you look at the units, again, any good quality townhouse or villa unit in Townsville is very attractive, even in Mackay as well. Mandurah, the market, and Perth. So you can see Perth is for good quality 1 and 2 bedroom apartments or townhouses or villa units. That market is extremely attractive at the moment, looking at our internal data sets. Melbourne's kind of moving along, Bendigo and Ballarat again. Geelong, you probably want to be staying away from, and Coffs Harbour and Newcastle and Launceston, especially Launceston in particular. It's probably a fairly dangerous market to be positioned in right now. But right now, I think Townsville's probably the market, and Perth unit market's probably looking very attractive currently. National, you can see that, since the last presentation, Adelaide's still moving along. It's probably been the best performing residential market over the last 4 or 5 years in terms of capital growth. And then Brisbane is definitely playing catch up now. I think Brisbane will outpace or, in terms of overperform in terms of that growth in Adelaide in, say, the next 12 months in comparison. Canberra's really moved along. Darwin, there's a really good opportunity there. Greater Hobart. Melbourne is probably the real opportunity in terms of allocating foundation assets in a client portfolio. So these are assets that what we're finding with our clients, they're perhaps generated 50 or 60% growth with some of their assets. They're paying down debt on their principal place of residences, and they're going to look at foundation assets. And I think the Melbourne market in that, $1 to $2 million price range, given the kind of non-performance of this market since 2018, it's actually starting to show really, really good value from our point of view. So we're going to be very, very active in Melbourne over the next 12 months. And it's definitely a market that we're going to start to buy quite aggressively over the next 12 months for our clients. Perth's up 62%, but we still see that there's a lot more to run in terms of the Perth housing market. We're not touching anything in Sydney at the moment, but it will probably represent an opportunity in the next 2 to 3 years. But there's probably better markets to be taking a position on right now. Vacancy rates. So you can see that vacancy rates nationally are still quite attractive. From our end, anything sub 1% is extremely attractive to us, and it suggests that we probably still will see pretty aggressive rental growth. Some of the regionals that I touched on before in the last research meeting, some of those regional rents are definitely slowing down, but the capital cities, obviously you're seeing a lot of investment grade stock being exited in Melbourne. I think rents will, aggressively rise in Melbourne. We're seeing rents rise in Brisbane. We're expecting strong rental growth in Perth over the next 6 months. So the markets that we're going to be taking a position on right now, I think from our end, we probably still might see that there will be some yield improvement. And for any clients that are holding assets within those markets, we probably feel that we should be pushing rents in all those markets over the next 12 to 18 months, which is really good from a serviceability point of view on their mortgages. Dwelling approvals, you can see that we've still got a shortage of dwelling approvals in the housing and unit sector. So, we're still short 109,000 houses and 59,000 units. So overall, we're probably, that's actually getting worse. and our footprint of, building 1.2 million houses that the government are telling, markets in terms of our housing supply, we're nowhere near hitting those particular metrics that they're putting out. So again, it's actually getting worse. You've got obviously heavy amounts of overseas migration still coming in, so we're not catering for that demand. So it's actually going to get worse over the next 12 to 24 months. Population movement I touched on obviously in the last slide, but you can see that there's 500,000 people expected to come in. That's not slowing down. Unemployment rate is still very attractive at the moment. So if the unemployment rate was a lot higher, I'd have some concern there, but there's still a significant amount of demand coming in. That's going to push rents up even further. So anyone that owns investment grade stock in their portfolio, residential, should see some kind of heavy kind of rental increases over the next 12 to 24 months. Perth, like I touched on Perth before, but look, we're aggressively buying in Perth. You can see the affordability index is still very, very attractive in our view. It still is really under in terms of its affordability index ceiling. So there's a lot more growth left in that Perth residential market. We have had some clients liquidate that have bought in 2020 that are already up, say 50 to 60%, but there's a lot more growth left in this kind of residential market. We don't see it slowing down. If we did see it slowing down, the affordability index would be a lot closer to 50, 60%, and we're not seeing that. So there's still a lot more uplift in the short term to medium term in our view for Perth. Price to income ratio is now running at 7 times. So it's gone from 5.5 to 7 times. So still obviously very, very low in comparison to Melbourne and Sydney and even Brisbane. And you can see the other attractive price to income metric is the price to income ratio for units as well. So it's still under 5 times, which shows us that houses may go on a little bit of a run and they may become unaffordable in the next 3 to 5 years. But the entry point for the unit market in those 1 to 2 bedroom assets is very attractive. So the housing and unit markets are very, very attractive at the moment in Perth. Median price, so we've seen a little bit of uplift, but it looked from 2008 to 2020, it's still playing catch up. So we still think the next 2 to 3 years are quite attractive for both units and houses in Perth. House versus unit, there's a nice little healthy gap there, but we don't really see that slowing down. So that suggests that probably units will go on a little bit more of a run over the next 12 months, but the housing sector is still very attractive. Household lending to owner-occupier lending, you can see that there's a little bit of investor lending activity, but there's a nice healthy gap between owner-occupier lending and investment lending. When we see that investor lending metric outpace owner-occupier lending, that's a bit of a concern, but still a nice healthy gap there. This is the concerning thing for us in Perth, and obviously with our buying team, we are seeing obviously stock levels. There's kind of 16,000 dwellings on the market for sale, and you've got this pretty significant amount of interstate migration coming in and overseas migration. Average days on market is sitting at 9 days. So, as soon as an agent lists a property in Perth, it sells in 9 days. So very, very aggressive market. And, predominantly, when we looked at the metrics last year of our buying team in Perth, 55% of all assets that were purchased by our buying team were off market, and that's increasing. So they've got a great network on the ground and buying a lot currently for our private clients off market. This is rent. So you can see that rents have jumped from $744 to nearly $800 a week now for a house. And you can see that rents in the unit sector have jumped from $560 to $625 in the unit sector. So, you've got a vacancy rate of 0.5%. It's really, really low. So we don't really see rents slowing down. So that increase in terms of rents increasing on the ground is very, very attractive. So if you buy a property over there, we probably see some pretty significant price growth, but you're going to get some really good rental growth as well for your unit or your house, which is good. Job vacancies. So job vacancies, there's plenty obviously available work on the ground for for assets currently, which is good in the obviously unemployment sector. So that's obviously very attractive as well. Sydney, I won't talk about Sydney too much, but you can see that the affordability index is still running at 87%. So 87% of a owner occupiers overall, if they had a 20% deposit and they were borrowing 80%, 87% is going into servicing home loan debt, which is extremely concerning for us. So unless you've got a very kind of wealthy mum and dad, I think it's very, very difficult to buy your own house in Sydney currently. So Sydney's traditionally had obviously higher levels of that affordability index, but 87% is just too concerning for us. Price to income ratio for housing is kind of almost still running at 14 times. So we've seen a slight decline, but nothing for us to say, let's go and buy in Sydney for units and housing. Nice healthy gap between houses and units, but from our end, there's far better markets to take a position on right now. I won't touch on this because we've talked about this on multiple of occasions, but the differential between the median house price and median unit price, there's a nice healthy gap there. Owner occupier lending, we've seen a kind of fallback in terms of people going out and buying their houses in Sydney. So that's no surprise. A lot more people are renting. Some people are obviously putting their properties on the market. So stock levels since our last research presentation have really increased. So this is showing that people's cash reserves, their ability to maintain that debt within their Sydney households has become a lot more difficult. So people are starting to put their houses on the market. Stock on market is running at 36,000. Average days on market is running at 30 days. So there's a lot more stock coming onto the market, which is a little bit of concern. And we're keeping our eyes on the Sydney market, but we're probably another 2 to 3 years off. Houses, for rents in terms of the vacancy rate is still at 1.5%. So we're seeing still relatively big increases for units. It's probably slowed down slightly, but for a house in Sydney, rents have gone from $1,000 a week up to $1,040. Job vacancies are very attractive for both private and public. Melbourne's an interesting one now. So as I discussed before, we're starting to buy in Melbourne for the first time in probably a long time as a business for us. So you can see the affordability index is trending downwards. So it's still running at 54% at the moment. And you can see in terms of the figures since 2019, 2018, and we haven't seen buying conditions this attractive for nearly 6 years as a business. So from our end, we probably feel that the right time is now in Melbourne for the first time in a long time. We're seeing that we probably will see rental growth. The price to income ratio in comparison to Sydney is trending downwards. So it's running at 8.5 times kind of price to income ratios for housing. And, it's probably running at 6 times. So both units and housing market in Melbourne is now quite attractive for us. It's distressed. There's a lot of people exiting the market. So that really creates an opportunity for us to take a long-term view in Melbourne. So if you're buying a foundation asset or an asset within the super fund, we're seeing a lot more client activity in that space. And we're just going to hold them long-term. We're never going to sell them down, and we're going to retain and hold. The gap between kind of the median house price and units is quite attractive as well. And you can see Melbourne since 1985, it really kind of ticks along. It's a very steady market. It's not as volatile as probably a number of different markets. We've had a little bit of a dip now, and I think probably the conditions are actually quite right now. So before they lower interest rates, and we might see some obviously deductions probably middle of late next year. Some people are talking about this happening sooner, but from our end, we think buying conditions are actually excellent at the moment for Melbourne. Melbourne house versus units, like we touched on this before, but there's a nice little healthy gap there. Household lending. So you're starting to see a little bit of, there's less investment lending, there's less owner occupier lending. So that, in terms of if you turn up to an auction and you go and you have a realistic budget, the chances are you should be able to secure that asset. So you're not competing with as many offshore buyers, you're not competing with as many investors, and you're not competing with a lot of owner occupiers. So I think the conditions now are actually quite attractive. Stock on market, again, there's more stock hitting the market. So there's 40,000 dwellings currently on the market for sale. Average days on market is 33 days. So that shows us that we've got a lot more opportunity to buy well. We don't have to rush into it, and there's going to be really good buying opportunities in Melbourne over the next 6 or 12 months. Rents are slowly starting to increase. So an average, you look at Sydney versus Melbourne, an average house is $1,000 in Sydney, it's $740 in Melbourne. You can see that rents are increasing in the unit sector. They've gone from $520 to $540 as well. Job vacancies are good across the board, still quite competitive. Brisbane, a lot of our clients, Brisbane's actually going on a little bit of a run again. It's kind of rebounded the last 12 months. Obviously, Queensland government are going on a very aggressive infrastructure rollout. So from that end, it's nearing towards the upper end in terms of its affordability index at kind of 55, 60%. Price to income ratio is probably higher than Melbourne as well. So it's cheaper to buy a house in Melbourne than it is in Brisbane at the moment for the same dollar value. So on a like-for-like basis, we probably feel that the Melbourne market's better value than Brisbane right now. So we don't see that quite often. So that creates an opportunity for our clients in Melbourne, but we've still got a hold recommendation for our clients in Brisbane. And, the next 2 to 3 years should still be quite good. Nice healthy gap. You can see the median price going up in Brisbane. It kind of dipped, probably 2 years ago, and it's now probably rebounded again. So a lot of owner occupier activity, still a lot of people buying, their dwellings between $1 and $2 million in Brisbane to move into their homes. So that's not slowing down. And even the units have gone on a little bit of a run as well. So there was a period of non-performance from, say, 2013 to 2020, and they probably really bottomed out around that 2018, 19, 20 period, but they're really starting to go on a little bit of a run. I think from our end, household lending, there's obviously a healthy amount of owner-occupier lending and investor lending at the moment occurring in Brisbane, which is good, which shows that there's a healthy market. Stock on market, the average days on market sitting at 18 days. So as soon as you put a property on the market in Brisbane, it's selling quite well. I think average days is usually 30 and it's at 18. So stock is moving. If it's good quality, it presents well to an owner occupier. I think the buyer depth on the ground is actually still quite strong. Vacancy rate 1.7. We've seen a slight increase there. Rents are kind of $748, for an average house at the moment. So very similar to Melbourne in terms of those figures, and rents are increasing slightly higher in the unit sector as well. Job vacancies are good. So with that big infrastructure rollout program that the Queensland government are doing, there's a lot of available work for engineers, trades, steel fabricators, scaffolders. All the trades and unions are doing actually quite well up there. So there's a lot of available work in particular industries, which is good. Townsville, again, this is another market that we're buying in. Affordability index is, quite low. It's running at 30%. It's had a really strong period of non-performance. So we actually think that the short-term to medium-term uplift in the housing sector is going to be quite attractive. Price to income ratio, again, you've got a population of more than 200,000 people living in Townsville. Very good diverse industry breakdown on the ground. Again, it's had a period of really strong non-performance, and it's really only starting to show value over the last 24 months. You can see that right now from 2008, very, very similar metrics to Perth in terms of it actually did negative growth from 2008 to 2020, and it's really only starting to play catch up now. So the last 18 months to 24 months have been quite good, but we think the medium, the 6 to 9 year runway of Townsville will be quite attractive for our clients. So for any good quality units or any good quality housing, I think it's quite an attractive market to take a position on. House versus units, both, good quality townhouses and good quality houses are probably the markets that we're taking a position on. We're not buying one bedders like we are in Perth, but there's really good quality assets there that 3-4 bedroom houses, 3-4 bedroom units or townhouses are quite attractive. Stock on market, again, this is signs that the market conditions are very, very healthy. Average days on market is 13 days. So again, as soon as it's listed, it's selling quite well to investors and owner occupiers. But you can see the amount of available stock. There's only 290 assets on the market currently for sale. So very little stock, very, very high demand. And we think it'll be quite strong over the next 3 to 5 years. Vacancy rate again is 1.6. You buy a really good quality house for 600, you're going to get 5 to 550 a week. So really good yield. And even in the unit sector as well, it's quite attractive as well. Household lending, healthy amounts of investor lending, healthy amounts of owner occupier lending. So that's not really slowing down, which is good. Job vacancies, obviously with the Defence Force there and obviously the new stadium being built, there's a lot of available work on the ground. So we really like Townsville because it's got quite a diverse industry breakdown. It's not heavily reliant on mining in comparison to some of the other Queensland regionals as well. So it very much reminds us of a kind of Ballarat, Bendigo, Wollongong, and Newcastle. And I think it's probably quite attractive from that end. So I'll finish up there. So if there's any questions, feel free to kind of reach out after this presentation. We will send through a link with today's research update for anyone that's missed the presentation. But I hope you have a really good Christmas and family break with your families, and we'll end it there. And thanks very much for joining.
Rightio. Thanks, Philip. We'll, as I said, get that recording out, and apologies to everyone with the mix-up with the email not going out. As I said, we'll get that recording out later this afternoon. Thanks, Phil, and thanks to everyone for attending.